Hey everybody, Chris Pulver here. Welcome back to another segment of the Pulver Report. We're trying to be profitable, not perfect. No, I'm not here today trying to look cool. Not because I have the hat on, it's because my hair wouldn't cooperate, and so I'm going to sport a hat today. All right. So today's question for the Pulver Report is, how does the stock market crash? All right. I know that that's a loaded question, but I think that it's really important we define the difference between crashes and corrections, because in today's volatility, what we are seeing more and more of are extremes. Right? You see this in the news, you see this in financial media outlets. These extremes, these headlines are there to grab your attention. Now, the good thing is, whether it's a crash or correction, we can survive both of them. But there are certainly decisions to make in preparing for dips and buying corrections versus doldrums and crashes. One day's headlines will read, S&P 500 to the moon, and the next day, sky's falling, the world is ending. Right? It's the SPY going to 5,000, or the Dow Jones going to 50,000. The bull markets can't be tamed, or it's the crash is coming. Build your bunker, stockpile toilet paper, paper towel, canned goods. Get ready for doomsday. Right? As I've said in other videos, it's important to be fundamentally aware, but also technically savvy. Let's have a little history lesson here. Since the 2008-2009 financial crisis, Great Recession, and the COVID crash in 2020, global central banks and governments have used an impressive toolkit of stimulus and accommodative monetary policy, and in my opinion, they have artificially engineered both recoveries and obnoxiously amazing gains over the last 13 years. Now, the argument can be made that without the Fed and without government intervention in 2008-2009, we were looking at a global economic crash, and contagion was a very real threat. So in 2007, the Federal Reserve responded to the subprime mortgage crisis with about $24 billion of liquidity added to the banking system. And by September 2008, Congress approved the $700 billion bailout for banks. It was known as the TARP program, or Troubled Asset Relief Program. Then in 2009, more money was added as economic stimulus, $787 billion, to help avert a global depression. Now, this was the ARRA, or the American Recovery and Reinvestment Act. Now, full disclosure, it wasn't all Fed to the rescue. There were certainly victims and disruptions from 2006-2009. Let's point out some of the notables. Lehman Brothers declared bankruptcy. The stock market crashed in 2008 with a 50+% fall. Unemployment stretched to 10% in 2009. Many argue that without the TARP, or the ARRA, and the additional economic stimulus programs, the Great Recession of 2008 could have easily become the second Great Depression. Now, fast forward 10 years, and it's 2019. The S&P is over 350% higher in those 10 years. That's 35% annual gains for just participating and holding in a post-recession period. Financial markets and risk appetite are fueled by excess liquidity, stimulus, lower interest rates, and although not explicitly stated, a Federal Reserve backstop and safety net. And then what happens? 2019 going to 2020, COVID, right? For anybody that traded stocks, options, Forex, and cryptos with me, if you trade with me in 2019 going into 2020, you know that I was actively bearish on the stock market, okay? So much so that I was long on inverse ETFs, which are instruments that will rise when the SPY, the Qs, the Dow go lower. And I was also long on volatility-related instruments. I'm looking for a substantial move higher in the fear gauge of the VIX, and I traded instruments like the VIXY, the VXX, the VIXM. Now again, there was a technical sign. I didn't see COVID coming. I don't think anybody really saw COVID as the fundamental market explanation. And I say that because we shrugged off a Trump election in 2016, North Korea threats, China and US geopolitical tensions, Russia, social unrest, uncertainty. So COVID was not necessarily high on my radar for the stock market to grab that and say, this is why we're going to drop. But the technical signs were there. So COVID was the little bow on top of that big bad grizzly bear that woke up and raged from February to March in 2020. And what happened? You guessed it. The Fed and governments to the rescue, and this time it was global. We had emergency interest rate cuts. We pumped more rescue stimulus into the markets. In fact, we pumped more stimulus in 1 year than we did over the course of 50 years. I dropped some big numbers for the Great Recession of 2008, like $700 billion, $787 billion. But that's child's play compared to what we pumped into the economies in 2020. And so the tail of the tape is the 2020 stock market crash began in March 2020. The Dow Jones had record-setting plunges over that period. In fact, we saw the largest point drop in history and the third largest percentage drop. We were seeing global fears and uncertainty about the spread of the coronavirus. Oil was crashing. We saw investors fleeing to safe haven and a stark possibility of a 2020 recession. But I suppose that this panic summoned the banking superpowers to make sure that we could beat it all over again. So the 2020 crash didn't last very long, and in fact barely even lingered. We literally went from 20 to 30+% declines to triple-digit rallies over the next 12 to 16 months. And it's even stretching as I'm talking about it right now. Now, from the COVID crash lows, the S&P 500 witnessed a 35% correction to a 115% rally. The Dow Jones experienced a 38% correction and a 100% rally from those lows. The NASDAQ led the motherlode of recoveries with a 31% correction in 2020 to a 145% rally. A fairly common sense assumption would be that a stock market crash, along with a pandemic and an inverted yield curve, would actually cause a recession. But not so fast, says Mr. Common Sense, because by June, the NASDAQ was back knocking on the doors of historical highs, a pre-pandemic recovery, and hasn't looked back since. By August, the S&P 500, the Dow Jones were testing the pre-pandemic highs, and by November 2020, we're seeing them both break higher, and they haven't looked back since. So how did the stock market display such amazing resiliency? Again, the toolkit. Central banks went from full percentage yields and interest rates to zero or near zero almost overnight. What else did the banks do? Aggressive bond buying programs, mortgage-backed securities, all this on a massive scale. We've already seen quantitative easing. We saw it from 2008, 2009. That was the past. This was pretty much QE unlimited easing for the foreseeable future until things looked better, right? So we're just throwing money at the problem, trying to beat it. So how about for people? We saw interest rates for auto loans, student loans, mortgages all drop dramatically. And the booming stock market recovery was helping investors, but not necessarily helping the working class. Investors recovered and have endured substantial growth in profits since 2008, 2009, since again the crash in 2020, but workers haven't really seen the same benefits. We had a big spike in unemployment in 2020. It spiked all the way up to 14.8% by April 2020. But we also saw state and federal unemployment benefits increased. We saw them extended. We had direct payments going to taxpayers, rental insurance, eviction moratoriums, and a bunch of other social programs were implemented to help everybody. And so what we actually have here is a 2020 stock market crash, a recession, a very uneven recovery, and this has been labeled as a K recovery, but we did this in a fraction of the time, right? And then, to top it all off, you have the COVID vaccine race. Investors were already looking ahead, pricing in optimism, and trying to get a handle to chart the course back to a new normal. So here we are now, one of the wildest sentiment swings, one of the wildest volatility swings, and this is some of the crazy stuff I have ever witnessed, ever studied, and ever traded in the financial markets. Literally every sector in 2021 is positive. The lowest earner is the XLP, which is consumer staples, at 9.46% year to date. The highest earning sector is XLE, or energy, which is up 53% year to date. It's been a remarkable year. It's been almost unbelievably bullish. And do I think that a crash is coming? No. But do I think a correction is coming? Yes. And what do I have to support this? Well, without the infinite excess cash supply directly to consumers, directly to the markets, directly to businesses, we would not have seen this robust and fast recovery. And sooner or later, the markets will have a reality period where it doesn't return 16 to 20% per year for doing nothing, right? Not where every sector is a winner, not where meme stock trading is the driving force behind these short squeezes. But for now, it's what's happening, right? It's why I play the game, and I'm playing the game to the best of my ability. I have certainly, easily left profits on the table, and I'm sure you have as well. But I'm doing just fine, and I can't, and you can't beat yourself up for hindsight trading and missing out. So I continue to trade, I stay in the present, I stay objective, I plan for the best, I prepare for the worst. Charlie Munger, okay, the sidekick of Warren Buffett, he has a great quote. If you watch the downside closely enough, the upside will take care of itself. And we have certainly seen that the last couple of years. This is kind of where I'm at right now. I don't need to become foolishly risky and naive because I do think that corrections are going to happen. Fundamentally and technically, things will fall into place. I see the technical clues now, so I'm preparing for the fundamental narrative to fit and support the direction I'm trading. Now, until then, I remain cautiously bullish on the stock market. I remain actively positioned in Forex, and I remain level-oriented on cryptos for accumulation phases to continue. For me, the next 3 to 5 years, I'm very bullish on cryptos. So I realize I just spewed 13 years of information at you with 2 crashes in the market, 2008, 2009 Great Recession, financial crisis, and 2020's COVID crash. But I'd love to hear your thoughts on it, right? The difference is crash is what we've had as kind of these anomaly events. Corrections are what we see that are pretty regular. 3, 4, 5%. Sometimes we can even have a healthy market cycle of 7 to 10, even 15% corrections. But this isn't a crash, even though the news and the headlines will make you think otherwise. It is really important that you know the difference, right? Keep your eye on the prize. We trade through corrections. We trade through crashes. If we have margin and dry powder, we certainly want to trade through crashes, but we have to also tolerate inevitable corrections, which right now I think we're at that point where it's coming soon. So if you have any questions about today's segment or you want me to go into more detail about something, let me know. And if you would kindly hit that thumbs up button for me, like the video, support my channel, I would greatly appreciate it. If you're interested in navigating the markets with me, if you're interested in trading live with me, you can look for my trading room links along with my social media handles in the description for this video. As always, thanks for watching. Happy trading, lots of profits, and cool guy, Pulver Report. My hair looks ridiculous. So anyway, thanks for watching. Have a great day, and I will see you in live markets. Take care.